All right, let's talk about one of the biggest debates in investing. It's a classic standoff, really. Should you consistently put your money in the market month after month? Or should you hoard your cash and wait for that perfect moment to strike when prices fall? This is a huge question, and we're going to break it all down.
I mean, this is it, right? This is the million-dollar question every single one of us asks, especially when we're starting out. If you nail the timing, you feel like an absolute genius. But if you get it wrong, you're kicking yourself for missing out on big gains. And this one question really sends us down two totally different paths.
So let's officially introduce the two big contenders in this debate. Because each one isn't just a strategy, It's a whole philosophy about how you think the market works and, honestly, how you should act as an investor.
So on one side, you've got the disciplined planner. This is the person who follows a system called dollar cost averaging. And on the other side, you've got the market timer, who's always trying to buy the dip. Let's dig into what these really mean.
Okay, so dollar cost averaging, or DCA for short, is actually pretty simple. You just commit to investing a set amount of cash, let's say $500, on a regular schedule, like the first of every single month. And here's the key. You do it no matter what. Market's soaring, you invest. Market's crashing, you still invest. The whole point is to average out what you pay for shares over time. When prices are low, your money automatically buys more, and when they're high, it just buys less.
Now, buying the dip. It sounds like a no-brainer, right? Who wouldn't want to get their favorite stocks at a discount? The whole idea is you sit on your cash, you wait for the market to take a nosedive, and then you swoop in and buy everything on sale. But what's the catch? Well, how do you really know when a dip has hit rock bottom? And what if the market just doesn't dip? What if it just keeps climbing?
To really see how these two mindsets work in the real world, let's tell a quick story. We're going to follow two imaginary investors for a year and see who comes out ahead. Okay, so meet Alex and Jordan. Alex is our disciplined planner. She's committed to her plan, $500 every month using dollar costs averaging. Simple. Jordan, on the other hand, is our market timer. He's got a $6,000 ready to go, but he's not investing a penny until the market drops by what he thinks is a decent amount, at least 10%.
So let's get this thing started. In the first few months of the year, the market gets a little choppy. It drops by 8%. Now that's not quite the 10% Jordan was looking for, but hey, it's definitely a dip.
So how do our investors react? Well, Jordan sees that 8% drop and he thinks, aha, this is just the start. It's definitely going lower. So he clutches his cash and waits. Meanwhile, Alex, she just sticks to the plan. Her automatic $500 investment goes through like clockwork, and since prices are down, she actually buys more shares than the month before.
But then something happens. Maybe there's some good news about the economy, who knows, but the market doesn't keep falling. In fact, it turns on a dime and starts to climb. And it doesn't stop. For the rest of the year, it's just an upward trend, never getting anywhere close to that 10% dip Jordan was so sure was coming. And here we are at the end of the year. What's the final score? Alex, by just being consistent, has invested her full $6,000 and enjoyed the entire market recovery and all the growth that came with it. And Jordan? He's still sitting on the sidelines, with his $6,000 in cash having missed the entire rally. His fear of not timing the bottom perfectly meant he missed out completely. Now that's a nice little story, but what does the cold, hard data say over a really long time? Well, let's look at this absolutely fascinating study from Charles Schwab that put these strategies to the ultimate test over 20 years.
So the study created 5 different investors and tracked them for 2 full decades, from 2003 all the way to 2022. Each one got $2,000 a year to put into the S&P 500. The only difference was how and when they invested it. Let's meet them.
First up, we have Peter Perfect. And this guy had a superpower. It was impossible, but somehow he knew the exact lowest point of the market every single year and invested his $2,000 on that one day for 20 years. His reward? He ended up with over $138,000. He's our gold standard, the unbeatable benchmark.
Next, we have Ashley Action. Ashley didn't mess around with trying to time anything. She just took her $2,000 and invested it all on the very first day of the year, every year, and moved on. So how'd she do? She ended up with over $127,000. Think about that, only about 11 grand less than the guy with a literal crystal ball.
And here is our guy, Matthew Monthly. He's our DCA investor. He took his $2,000 and broke it up into 12 equal chunks, investing a little bit each month. No stress, no guesswork. His reward for that consistent, disciplined approach was more than $124,000. He's right on Ashley's heels, proving that just being consistent is incredibly powerful.
Okay, now this one is incredible. Meet Rosie Rotten. Rosie had the absolute worst luck you could possibly imagine. Every single year, for 20 years, she managed to invest her $2,000 at the very peak of the market, literally the worst possible day to invest. And yet, she still ended up with over $121,000. Why? Because her money was in the market doing the work.
And finally, we have Larry Linger. Larry is our buy-the-dip investor who, just like our friend Jordan, never found a dip he was confident enough to buy. He waited and waited and waited for that perfect moment that just never seemed to arrive. His money just sat in cash. After 20 years, he had just a little over $44,000.
When you see it like this on a bar chart, the takeaway is just, wow. It's so clear. Look at the top 4 bars. From Peter Perfect all the way down to Rosie Rotten, the one with the worst timing ever. They're all in the same ballpark. But then look at that massive cliff. That's Larry. The one who got left in the dust was the one who was too afraid to invest. The cost of waiting was so much greater than the cost of even the worst possible timing.
And this really gets us to the heart of the matter. This whole debate, it's not really about charts and spreadsheets. It's about psychology. It's about picking a strategy that you, as a human being, can actually stick with when things get scary.
And look, you don't have to take my word for it. The legend himself, Warren Buffett, says this all the time. For most of us, he says, the best thing to do isn't to try and outsmart the market, but to just be consistent. You remove the guesswork and you let time work its magic.
And this is where a strategy like dollar cost averaging really shines. It's almost perfectly designed for how our brains work. It puts your investing on autopilot, so you don't have to make these huge, stressful decisions. It builds a good habit, it helps you tune out the noise and avoid panicking, and most important of all, it keeps you from procrastinating, which is what hurt Larry so badly.
So I'll leave you with this one last thing to think about. Trying to time the market might seem like the smartest way to play the game, but the best strategy, the one that actually works, is probably the one that accepts that we're all human. So, is your plan built to withstand your own emotions? Can it survive your own fear and greed? Because at the end of the day, that might be the only question that truly matters.